Welcome to today's webinar. It's on how is the financial services landscape changing in the UK. We're going to deliver today a YouGov perspective on the financial service sector using lots of our data. My name's Matt Palfreman. I head up our financial services custom research team based in the UK. I've been at YouGov for about 3 years or just over. And prior to my role here, I was working sort of client side, so experience from both sides of the fence, but all of which has been within the financial services sector. So hopefully you'll enjoy today's presentation, and we're going to share with you some of our insights from lots of our data that we use to track what's going on in the sector, and perhaps inform sort of strategic decision making across many of our clients within the sector also. So the session's going to last for an hour. I'm hoping that I'll be through the main presentation within about 45 minutes, after which there will be time to answer some of your questions. So if you do have any questions, if you could use the chat facility to post those questions, one of my colleagues in the marketing team, Rachel, will be keeping an eye on that. And then at the end of the presentation, she will fire some of those questions at me and we'll answer as many as we can. If we don't get round to answering all of your questions, we will be following up after today's session with a copy of the presentation. So don't worry, you will receive a copy of these slides, and also we will answer any outstanding questions that we don't get round to today. So don't worry if your question doesn't get answered, but if you could post them as and when we're going through the presentation, that would be great. This presentation is being recorded as well, just to let you know, and you will be able to access a recording of the presentation, either because you want to listen to it again, which would be great, or you can share it with some of your colleagues who can listen to it afterwards. Okay, so let's get into it. Before we get into the actual main presentation, I just want to talk to you a little bit about YouGov. Hopefully many of you already work with us or have worked with us, or at least know what we do. But for those of you that don't, YouGov is a data and analytics company focused on collecting consumer opinion and behavioral data across the globe. We were built on the principles of empowering and the voice of consumers to help companies make better decisions. So it's all about capturing the voice of the nation, in this case the UK, or globally, and then making sure that we're able to use that information to help organizations make better decisions. So turn it into insight, which can then be used. And we're collecting lots of information around the globe. So there's some big numbers on this slide. We have about 9.6 million people participating in YouGov panels worldwide. So we're getting very close to that 10 million mark. We have lots of historical data on lots of brands, up to 11 years worth of historical data, some of which we'll share today. We've got 44 panels worldwide, where we track lots of different brands across those markets as well. And we have over 1 million different data variables on YouGov panelists worldwide. So it's big data, but it's what we do with that big data is the most important thing. We're very proud to say that we are the most quoted research agency in the UK, number 2 in Italy and number 3 in Singapore. But I'm sure, in time we'll move ourselves up the rankings in both those markets and as well as others. And we have we completed, just by way of numbers, we completed over 40 million surveys in 2019. So that's just giving you an idea of the size of the data that we're capturing across the globe. So how do we make the most of that data? Well, it all exists within what we call the YouGov Cube. The YouGov Cube is in effect our connected data solution. It allows us to look at all of those data points and then extract maximum value from what is very big data. And hopefully we'll be able to show you how that works today. So just a quick mention, this is the last slide on YouGov, I promise, and then we'll get into the actual presentation. We have a suite of products underpinned by great technology, which integrates all of our data streams. So here you'll see on the right-hand side a range of the different data solutions and products that we offer. YouGov Brand Index, our global syndicated brand tracker. Profiles is our audience profiling and segmentation tool. We have YouGov Real Time, which is our incredibly quick custom surveys. You can ask the questions today, get your data tomorrow or your answers tomorrow. It's that quick. YouGov Sports Index, which is a global sports fan tracker. We've got Custom, which is our end-to-end bespoke research. So some of that more involved research, that's an area within which I specialize. We've got YouGov Direct, which is about advertising. And then we've got our Collaborate platform, which allows our clients to create their own surveys and push those out to our panelists. And there's a range of other ones. I won't go through all of these. We have a wide range of data solutions. The key reason for showing this chart is we're going to reference some of these data services and solutions as we go through the presentation. The idea of today is to show how through all of this data we can sort of stitch it together and tell a compelling story around what's going on, in this case in the financial services market. So without further ado, we'll crack on with the main presentation. Now, before I go to the first slide, I've thought about this in sort of three ways. And we've split the presentation into kind of three broad focuses. First of all, we're going to have a look backwards. We're going to have a look at how things have changed since the financial crisis of 2008. You know, perhaps that's old ground, and many of you are more than familiar with what happened and how it's impacted on the financial services industry. But I think it's important that we remind ourselves where we've been, and perhaps where we were as we then approached the latest crisis, that being COVID-19. So we're going to have a look at where we've been. We're then going to look at COVID-19 and have a look at some of the immediate impacts that COVID-19 has had, is having, and perhaps will have on people's relationship with their finances. And then towards the end, we'll really leave it with a consideration for the implications going forward and some of the main challenges that may exist for the future within the financial services sector. So without further ado, we'll move on to that first bit of looking backwards. And I think the first thing that nobody would disagree with is that the financial services sector changed considerably after the financial crisis in 2008. And that's really proven by our brand index data here. This is UK data, which is tracking the general impression of banks and building societies. So we're looking at the percentage of people that have a positive impression of those banks or building societies minus those that have a negative impression, giving a net score. So we can see that in 2007, it was net positive, 8.6%. So generally, there was a more positive impression of the banks and building societies before the financial crisis. No surprise that it dropped considerably after the financial crisis, initially dropping to minus 3.6. And then as there was more and more scandals being revealed, I guess, over the coming years and negative media coverage, it's perhaps no surprise again to see it drop further to minus 5.1%. So we really moved from a sort of positive impression of the sector to a negative view of the sector as a result of the financial crisis. And that really sets the agenda for the following sort of 10 years, I guess, that the focus has been, I guess, on rebuilding the reputation across the financial services sector. And to a certain extent, you know, that's been achieved in that we have now moved back into positive territory. So the general impression of sort of banks and building societies in this case is now plus 5.3, not where it was pre-financial crisis, but you can see here that trend seems to be continuing in an upwards trajectory. So there is a conclusion that, you know, perhaps over the last 10 years that the reputation has recovered, but it's been a long slog, and we'll sort of talk about some of the impacts of that's had on the market during that period. We of course have other data. I've just shown banks and building societies here. We have this same data for all of the other subsectors within the financial services industry, but I think it really was the banks and building societies where we saw the biggest impacts. And through that period, there's been a recognition that there needs to be more regulation within the sector. Some of the poor behaviour of the banks was exposed after the financial crisis. We can see some of the things that sort of came out on the left-hand side there, and perhaps no surprise that resulted in significant increases in regulatory pressure from the regulators. So I think a lot of that period has been trying to meet those new regulations or you know, shore up the balance sheets, for example, and make sure that the banks are now behaving more responsibly. But that's had the impact of putting increased strain on traditional revenue streams. So some of the traditional revenue streams have kind of dried up or have been made more challenging through increased regulation. And it's also resulted in increased operating costs. So we can see the share price of the big four banks here taking a hit as a result of the financial crisis and perhaps not really recovering to where they were before. And also the cost to income ratio on the right-hand side here is reflective of both a reduction in the sort of traditional revenue streams, but also increased operating costs as a result of that significant increase in regulatory overheads. So what has that meant? So I think that's all well established, and nothing there is a surprise to anybody. But it's just to remind ourselves, you know, what happened over that period. But I think what it's meant in terms of consumers is that a reduction in costs and a focus on driving efficiency has potentially meant that the perception that all banks are the same has increased. So we're seeing a stat here: 71% of a NatRep population consider that all banks are basically the same. So really, what we're seeing here, and we see this in lots of other data, is consumers don't really see any obvious or clear points of differentiation, at least between the sort of more traditional and established providers. And perhaps that's no surprise where they've been focusing on other areas and perhaps driving greater efficiency, often through at the sort of I guess the sacrifice of what they offer to their consumers. But as it stands at the moment, and for a long period of time, it seems that many consumers don't really see any real differentiation between what the banks have to offer. That translates to sort of 1 in 3 also saying that they don't trust banks or building societies. So still, as a result of the crisis perhaps, but also the fact that the banks and building societies and other financial institutions for that matter are focused on other areas and perhaps haven't been seen to be truly giving something back to consumers. There's a general lack of trust out there for the industry still. It has improved since the financial crisis, but we'd still flag it as a kind of barrier, I guess, to sort of real engagement with the sector. And again, at the bottom there, I don't trust insurance companies to act in my best interests. That stands at 45%. So there's some big proportions of the population here that hold these sort of negative views, I guess, about the industry. And we think that really reflects in a lack of motivation out there amongst consumers. And that's reflected, if we look on the right-hand side, in the sort of switching data. And this is from our own panel. So this is YouGov profiles data. We're monitoring these things on a regular basis. And when we looked at this, we found that 4.8% of the population said that they were intending to switch their current account in the next 12 months. So that's not many people. That's quite a minority that are planning to do that. And then the reality is that just 1.4% of the population actually go on to do that. So looking at the percentages that say they've switched their account in the last 12 months. And I guess no one would argue that the sort of switching volumes aren't quite where they need to be, or where the Competition and Markets Authority would like them to be, despite their best efforts. But we think this is why that people just don't think it's worth switching, as they think if I switch to another provider, I'm just going to get the same thing from a different brand, and they're potentially more engaged with other kind of facets of their life, or at least have been over the last sort of 10 years or since the crisis. And I think what this means, and we've sort of presented on this before in other presentations, we believe the market is rife for disruption, and perhaps still is. It certainly has been since the financial crisis. But so far progress has been slow. So it's a fairly stagnant market. Lots of the big players are really focused on sort of shoring up their balance sheets or meeting those new regulatory requirements. So really, with a lack of real investment in sort of innovation, the market is rife for disruption. But like it says here, so far progress has been slow. So the CMA recognized the same thing, exactly the same thing, and it was the same reality that made them conduct an investigation into the sector. They released a report about how to make banks work harder for you, i.e. you as consumers, and there was a range of CMA remedies that were released over the last sort of 10 years or so, aimed at trying to stimulate the market and motivate consumers to sort of switch and maybe try new providers. So it's really sort of opened up the market for the likes of Monzo, Revolut, Atom, Starling, N26, Metro, to name a few, brands that we would call challenger brands. So if you hear me say challenger brands, it's these sort of brands that I'm referring to. So really, with these initiatives and the state of the market, it should have really been rife for disruption. But as I said, so far progress has been slow. Here we are tracking current customer percentages through Brand Index, and we can see Monzo. We've been tracking Monzo for a very long time, so we can see sort of slow and steady growth, I guess, for Monzo, driving growth from sort of 2% of consumers saying that they are current customers of Monzo, up to nearly 6% in a sort of 2-year period. So that's decent growth of current customers, but it is kind of steady. And then we've also charted Starling and Revolut, who we started tracking a bit more recently. Perhaps the growth is a bit slower for those brands, especially Revolut. But I think that's what we conclude. It hasn't really been a banking revolution with these brands, more of a sort of evolution as they slowly grow in terms of their size and the number of customers that they have. But I guess key to their success isn't the fact that they just have customers. We know that lots of their customers are using them as a secondary financial provider. And when we look at the data of main current account market share, we see that 75% of the market is still dominated by the big banks and building societies. And even Monzo, who's the kind of, I guess, the success story amongst the challengers, still accounts for just 0.9% of main current account market share. And from from talking to some of the challenger brands and lots of articles that are out there, I guess the key to their success is getting more consumers to commit to them fully. So their percentage market share in terms of main current account is an important metric for them, and perhaps that hasn't moved at the same pace as the overall customer numbers that we saw on the previous slide. And it's perhaps no surprise on the right hand side here, we're also looking at spontaneous awareness of any challenger brand. So we ran some research looking at perhaps we set ourselves the challenge to say, well, okay, why aren't more people committing to challenger brands? Or in a market where people see the big banks as sort of old, tired, not really offering anything new or innovative, why aren't more people gravitating towards Monzo, Starling or Revolut? And we actually found that at a nat rep level, at least, spontaneous awareness of those challenger brands is very low. Less than 1 in 10 of consumers could off the top of their head name any challenger brand. And we gave a full definition of what we meant by a challenger brand, so don't worry about that. But just less than 1 in 10 were able to mention one. Monzo is top, but just 5%, Starling 3%, Revolut 1%. So what this really means is for the mass market, at least, these challenger brands are not top of mind. So they're not really cutting through on a mass footing, and we think that's really important for their success. And we know that retail banking, at least, is a kind of a mass market business, and unless they're able to sort of cut through on that sort of footing, they may continue to struggle in this particular market. And also we looked at it within that same piece of research, looking at why challenger brands have perhaps not cut through to the extent to which people expected, wanted, hoped, thought they would. We look at some of our other data points which helps to explain that. Despite being underwhelmed with sort of traditional banks and providers, and despite what I said earlier about the percentage of people that think that they offer the same thing, and there's a highish percentage that say they don't trust them, then what we're looking at is the difference between trust in the sector. And this was something that was revealed from some research done by our reputation team many years ago. We revealed after the financial crisis that whilst people don't trust the sector as a whole, so the kind of terminology is I don't trust banks or building societies, they do trust their bank. So trust operates on 2 levels, we found within that research. So whilst they may not trust the sector as a whole, and they have this view that all banks are the same and there's not much differentiation there, when it comes to their bank that they use every day, trust is different. It's, do I trust you to be able to look after my money? Do I trust that when I go to the ATM, I'm going to get my money out? Do I trust that when I make an overseas payment, it's going to get there? And for 68% of the population, they do trust their bank in order to get it right and deliver what they need. We also see 48%, nearly 1 in 2, says that their bank provides great service. So this is great service, not just acceptable service. If we broaden that out to include okay service, it would be even higher. So a large percentage of the population are generally satisfied with what their bank offers and delivers. Many of them trust their bank, even though they may not trust the sector as a whole. And as a result, 1 in 2 would go on to say, I would recommend my bank as well. So these numbers aren't very high. I mean, if you looked at the equivalent numbers for, say, a brand like First Direct, they would be a lot higher. But the conclusion is they're kind of good enough. For most consumers, it's good enough. And as a result of that, there's a lack of what we call sort of push factors motivating them to want to go and look for an alternative. So that then places the emphasis on the challenger brands to have a strong enough pull factor to overcome that sort of lethargy which exists there in the market. And when we look at some of the data, looking at the sort of mass market view of some of these challenger brands, it's perhaps not strong enough to to convince people that they need to sort of leave their current bank and go and use a challenger brand. Challenger brands are just as reliable and trustworthy as traditional banks. Just 1 in 5 people believe that to be true. Challenger brands are easier to use than traditional banks. Again, 1 in 5, so it's a minority believe that to be true. And slightly higher, 1 in 3 or a third of consumers believe that these challenger brands do actually offer new and truly innovative products and services. So slightly higher percentage there, which is expected given the nature of these brands and what they do. But again, we'd conclude from this that their appeal at the moment is kind of niche in that they don't have the sort of mass market appeal that they may need to really cut through and challenge some of the bigger players in the market. So we're now going to, so that's kind of where we've kind of been, and we've done a lot of work on around sort of open banking and switching, and why aren't people more switching, and what is the impact of open banking, and we did the piece on challenger brands and perhaps why they hadn't cut through or been as successful as we may have thought or hoped. And that really, a lot of the research we've done over the last sort of 2 or 3 years has been focused in on those sort of areas. And really it takes us to today, and we're about to, we've already embarked on, I guess, a new chapter, I guess, in society, with COVID-19 being a pretty big event, perhaps once in a lifetime, well, hopefully a once in a lifetime event, which has had a significant impact on consumers, full stop, let alone their relationship with their finances. But because this is a financial services webinar, we're going to focus in on how we think COVID-19 is impacting consumers, and then that'll lead us on to how we think such a large scale global crisis could and perhaps will change the landscape going forward. We think it's going to perhaps accelerate some existing trends that we'd already spotted, but it also may result in some new sort of consumer behavior that perhaps we hadn't anticipated previously. So we'll get to that towards the end of the presentation. But initially, let's look at COVID-19. So when the pandemic hit, I've probably been working from home for a couple of weeks, and I was looking over some data from our YouGov debt tracker. So our YouGov debt tracker is a syndicated product. We've been tracking quarterly the extent to which people are keeping up with their bills and financial commitments. It basically measures lots of other things, but one of the key measures is how well are people doing financially. So we thought we went into field, or we did our last quarterly wave in February 2020, just before COVID-19 really hit and just before we went into lockdown. So we actually ran a special interim wave of the debt tracker 5 weeks into lockdown to see if we could pick up on the initial impact of the crisis on consumers and their ability to meet their financial obligations. And then again, so that's the April 20 wave you're seeing on this chart. And then we ran our standard quarterly wave in May 20. So we've got a couple of data points post-COVID to work with. And it's really revealed some interesting findings. Initially, we were surprised to see that the percentage of the UK population that said that they were keeping up without difficulties actually increased significantly 5 weeks into lockdown. So it jumped from sort of 47% there. I haven't included the data label, I wish I had, but it's 47% up to around sort of 53% or thereabouts by April 20. And then by May 20, that's gone up to 60%. So we've seen a significant increase in the population of the percentage of people that say that they're keeping up with their commitments without difficulty. We've seen a reduction in the people that say they're struggling from time to time. And we've seen a reduction in the people that we would classify as financially distressed. So when we first saw this, we thought that's strange, that's a surprise. But as we started digging through the data, it made sense, with lots of people being in lockdown and perhaps not yet having experienced any impact on their income, but enjoying perhaps reduced outgoings, both through circumstance and their own motivations to sort of cut down on non-essential spending. It was perhaps no surprise that people were sort of finding that they had more just maybe disposable income, or they were more comfortable in terms of meeting their financial obligations. So it started to make sense to us that that was the case. So on the surface of things, if we look at this, well, great, COVID-19's coming in, but the impact on people's finances is that people are managing better than they were before. But it quickly became apparent that the average really masks the reality. And when we look at the people that are already financially distressed, we started looking through a lot of the data and realizing that it was that group that was being impacted the most by COVID-19, both in the short term, sort of 5 weeks after lockdown, and also we believe in the longer term. And we'll explain it. We'll touch on a little bit. I mean, there was a whole separate presentation on this, but we'll touch a little bit today on why we think that to be the case. But this chart here shows the percentage of all Brits on the left-hand side that either felt that COVID-19 has had a positive impact on their household financial situation, no impact, or a negative impact. So 34% of all Brits quote that it's had a negative impact. But if we look at the right-hand side, 70% of the people that are financially distressed said that the crisis has had a direct negative impact on their situation. However, we also see another group, the work from home group, which is perhaps you and I, and or many people on this call are perhaps lucky enough that we can work from home without real disruption. Certainly at YouGov, we've been surprised well, actually not surprised, because I think we were pretty well set up anyway to sort of work remotely, but it's been pretty seamless, and we've been lucky enough to be able to carry on operating and working in this way. And perhaps therefore it's no surprise to see that amongst the working from home group, the middle chart here, 1 in 3 are actually citing a positive impact on their household situation, which perhaps explains the sort of the direction of the data we saw on the previous chart. But it's important that we zero in on the most vulnerable, and for this particular research, it's that financially distressed group and the fact that they're struggling more than ever. So just to call out some of the stats from the research, the financially distressed are really struggling and really facing an uncertain future. So 77% of financially distressed people said they've suffered a loss of income as a result of COVID-19. The average percentage of their income that they claim to have lost is 66%, which is huge. And 36% believe it will take at least a year for them to recover from the financial impact of COVID-19. Those are some big numbers, and perhaps rather worrying for those people. If we look at the impact of COVID-19 on their level of debt, 41% say that their level of debt has increased as a result of COVID-19. 61% who have missed a payment attribute that directly to COVID-19, i.e. I wouldn't have missed this payment if it wasn't for sort of lockdown and the impact of that on my financial situation. And 67% are worried that they won't be able to repay their debts in the future. And the bottom one we looked at is the impact on their sort of household, really, or their behavior. 82% have stopped buying anything that's not essential. That's a general trend across society. Even if you're not financially distressed, we see that most people are cutting down on non-essential spending, but it's even higher amongst this group. And perhaps worryingly, we actually revealed some worrying statistics around behavioural change. 37% said that they'd eaten less than normal as a result of the pressure they were under, and 31% said they'd reduced the number of showers or baths they take. So really, the research has really showed that on the surface of things, and if the average can mask the reality, that if we just look at a NatRep population and the average percentage of people that are financially distressed, it may look positive, but actually underneath there's a smaller percentage that are struggling, and as a result of the pandemic are struggling more than they ever have been. The research also shows that 1 in 5 have experienced a negative change to their employment and are worried about their future. So we can isolate through our research UK adults or GB adults that have experienced a negative change to employment. So here we were looking at people that said they'd either been furloughed, they'd had reduced hours, they'd been told to go on unpaid leave, or they'd ceased trading. Any people that had experienced a negative change to their work or their employment. And we're able to then isolate that group and reveal that it represents 20% of the GB population. But then what we're able to do is upload that data into our cube and look at all of our connected data associated to that 20% of the population. And then we can really answer who they are. So we know that the people that have been impacted the most tend to be younger, 18 to 34, 85% live in urban areas, 14.6% in London. They're much more likely to have children. And when they do have children, they're more likely to have two or more. So, real financial, I was going to say a burden, but that sounds wrong, but you know what I mean. Kids are expensive. So really that perhaps represents an increased challenge for them. They're less likely to have a mortgage, more likely to be paying rent. So again, when it comes to things like mortgage payment holiday, well, data may actually reveal that the people that need it most don't have a mortgage. So, what support is for people that are renting. They're twice as likely to be self-employed. So again, the sort of, the furlough scheme, although they can sort of self-furlough, may not be as effective. They worry they'll never be able to save for a rainy day. They're more likely to be confused by financial matters, and so on and so forth. I've just called out some of the significant differences that we identify within this group when we compare them to the NatRep population. And that's where our profiling data becomes really powerful. So we can isolate a group, compare their situation, their demographics, their attitudes, their behaviors, compare it to the wider population, and then really get to know these people in more detail. But perhaps when we look at some of these data points and some of these differences in terms of who they are, it helps us to understand perhaps how we can help them and what initiatives need to be deployed in order to help these people the most. And when we look at the people on furlough, we can see quite understandably, and there's lots of coverage of this in the media, both at the moment, last week, weeks ago, and there will be in the future running up to sort of October. 65% of people on furlough are worried about losing their job. 59% are worried about their ability to cope with other financial emergencies. It's no surprise they're on furlough, so things are okay now. But there is this view for the future, which is a lot more pessimistic, and people are really worried about their futures, especially those that are currently on furlough, understandably. But also across the NatRep population. So even if you haven't been impacted directly, most people, well, not most people, we've seen a significant increase, I should say, in the percentage of the population that are worried about the future. So in the middle here, we've seen a jump of, we saw initially a jump of 8% in the percentage of the population that felt their financial circumstances would get worse over the next 12 months. So historically, it's always been that people are more optimistic. So, prior to sort of COVID, 1 in 3 was sort of saying it would get better, with around 1 in 4 saying it would get worse. That pretty much flipped as a result of COVID-19. And we now see that around 1 in 3 are worried about their future or the next 12 months. And that perhaps explains some of the behavioral change we've also seen connected to that. And we'll talk a bit later about sort of a more conservative attitude to finances and some of the changes that people are making to sort of in anticipation for more challenging times ahead. So I guess the finding here is that on the surface of things, if we look at the sort of NatRep population as a whole, on the surface of things, you may miss the real impact of COVID-19. The sharp impact initially has been on those that are struggling the most, but many people are worried about their future and being impacted at some time over the next 12 months. So we know that many companies during a crisis consider how to respond, and we've certainly seen that in this crisis with varying examples of how companies, not just within financial services, have responded to the crisis, and I'd say with varying degrees of success. So with our data and our ability to track brand sentiment through Brand Index, so the slide we're looking at here is Brand Index buzz and reputation scores. So buzz is the net percentage of people that have seen, read, or heard something positive about that brand. So we look at the positive minus the negative, and that gives you a net buzz score. And then reputation scores as well from the same data source. And the example we've used here is Admiral. So Admiral decided to give £25 refunds as cars and vans sat idle during the lockdown or sit idle during the lockdown. And we can see that had a significant impact on buzz for Admiral out there in the market, which then reflected in increased positivity around the brand in general. And we could then go on to sort of monitor levels of consideration, and we would expect to see sort of levels of brand awareness, top of mind awareness, consideration. We'd expect as a result of these movements for those other metrics to also move, perhaps helping Admiral to be more successful in the market. That's perhaps not why they've done this, and it was certainly a very costly thing to do. But we have the ability through Brand Index to monitor how companies how companies respond during a crisis and what that impact has on their brand equity. And certainly Admiral is sort of placed as a positive example of maybe doing the right thing or being seen to do the right thing, and then the sort of benefits that that has to your brand. We do have we do have examples of brands which have perhaps not done the right thing or not been seen to do the right thing, I should say, and we see some similar charts like this that go the other way. I've decided not to include them. We don't like to name and shame brands, especially on a call such as this, but we do have the data where we can also monitor things that have perhaps gone the other way, and look at how quickly things take to recover if there has been any brand damage done as a result of any crisis, not just COVID-19. But certainly the sort of the question is, how are brands going to respond? How are they responding, and how will that impact on their brand equity going forward? This is some work that was done by our reputation team. So Oliver Rowe heads up our YouGov reputation team. He specialises in the reputation of lots of different companies, not just financial services, but does a lot of work in that space. But they've done some work here looking at how well or poorly do you think that the different sectors of the UK economy have behaved in the face of the coronavirus outbreak. And we can see here that while supermarkets, food and drink manufacturers, pharma, technology, they're all got a very positive net score here. Financial services does have a positive net score, but it's pretty much down the list here, fairly low down, and perhaps apart from airlines, holiday companies, and the media, has the sort of lowest positive view here from consumers in terms of how the sector is responding to the crisis as a whole. So it does kind of call into question, well, is there more that could be done? We know that some companies such as Admiral have done things, other banks have sort of put adverts out there, but is it cutting through, and is it doing enough? And are consumers seeing enough of that to have a conclusion that the sort of financial services industry is a force for good during a crisis? And I think that's, as we move forward, what more and more consumers are expecting to see from the companies that they use, that they're supporting society and helping through times of need. So we think that COVID-19 is likely to have a lasting impact and influence on how consumers manage their finances in the future. There's a few, like I said, there's a few trends that I think will potentially accelerate as a result of COVID-19, and perhaps a few new things that we need to consider as we go forward in terms of behavioural change and how consumers will manage their finances. So first of all, we ran some questions actually last week. So we used our real-time service, which is nearly close to real-time research, in that we wrote the questions on the Tuesday and got the data on the Wednesday, which is always nice. But from that research, we wanted to just capture the mindset of the nation, right up till last week. And the way we did that was asking a sort of typical question in terms of their main focus or priority over the next 12 months. Are they planning for the future, or are they living for today? So are they focused on what they're going to be doing in 12 months time or 5 years time, the typical 5-year plan or whatever, or are they focusing on enjoying themselves and making the most of their lives in the now? And we found that 50% of the population are planning for the future. They're more likely to be male, more likely to be aged 18 to 45, working full time, and students tend to fall into this planning mindset more than the rest of the population. Whereas Live for Today, it was more gender neutral, but definitely older, and that connects to, I guess, retirement. When people retire, they want to enjoy their retirement. There's perhaps less need to think about the future as much, or they tend to be working part-time as well. So some of this makes intuitive sense, but it does also perhaps suggest that there's a more conservative attitude for the future, and that more people are planning rather than sort of living for today, and the impact that will have on sort of spending, and as we come out of lockdown, are they going to return to their old ways and go back out? Well, certainly over the weekend, I'm sure lots of people went back to the pubs, but will that prevail? Will people be going on holiday as much? We have lots of other data connected to all of those things around how, as part of our consumer sector. I haven't shared that in this presentation today because we probably haven't got time to cover it all, but we know that there are going to be big changes to consumers in terms of what they spend their money on and how they live their lives. And it would certainly sort of correlate with a more conservative attitude and a more planning focus for the future. And that's really reflected in this other data here we've been tracking for a while. I've labeled this as YouGov real time, but this is actually from our YouGov household economic activity tracker. We've asked this hypothetical question for a number of years. What would you do with an unexpected windfall? The full question is equivalent to 1 month's salary. So if you had a windfall of 1 month's salary, what would you do with it? And it's a good way of checking the sort of mindset of the nation, similar to the previous question. And historically, we've seen around 1 in 5 saying they would spend it. We've seen around half of the population saying they would save it. And we've seen some changes in the percentage that say they will repay debts. But in 2020 here, the one that sticks out is the increase in the percentage that say they're going to save it. So we think through this data, we're also evidencing a more sort of conservative attitude to finances. And we know from other data, many people are focusing on that emergency savings. So just to flag a few other data points which we captured through this research as well, we found that 47% of the population said they will not use cash unless absolutely necessary in the future, and we know that's a growing trend. So before the COVID crisis, we knew that less and less people were using cash. With contactless and the limits going up, there was a natural trend that the usage of cash was in decline. But we think as a result of COVID, that trend will accelerate, where people are more reluctant to use physical money and more likely to want to use contactless payments. 41% will avoid using a bank branch wherever possible. Again, there was a trend for decreasing usage of branch networks, and we know lots of banks have sort of reduced the size of their estates in that respect, quite controversially often. It often makes the press that those branch closures, but perhaps what we're seeing here is a shift in mindset that many consumers don't want to use branches anymore. They prefer to do things remotely, and perhaps that'll make it easier for those programs to continue, or will accelerate that trend of people not using branches. 54% will cut back on non-essential spending, so it's higher amongst the financially distressed, but it's still very high amongst the NatRep population. And connected to less people wanting to use branches, we see that 63% will want to use digital service channels such as mobile banking wherever possible. So we could find that there's increased demand for those digital service channels. I think a lot of these things were trends that were happening already, but we think as a result of COVID, or a specific result of COVID, that those trends will accelerate. 62% say they won't need to borrow money to achieve their ambitions. So we also find that there's an attitude out there that people don't want to borrow money. In the current climate, I think many people have been forced to borrow money or get into more debt, but we know that there's a general reluctance to want to use credit, and I think that's reflected here. Whether or not people are successful in not using or not borrowing money to achieve their ambitions is another question, but there's certainly a desire not to. And perhaps the last one, going back to the challenge that challenger brands face, perhaps that could become more challenging, where 64% of the population say they will only use established and recognized financial services providers. Now, we know from previous research that there was more comfort in using those traditional and well-established brands anyway, but during a crisis such as COVID-19 and the associated economic sort of headwinds ahead, it may be no surprise to see more people gravitating towards what they consider to be bigger, more reliable brands in the future. We also asked for financial priorities over the next 12 months, and 52% of the population just want to be able to live and enjoy their lives. So that came through really strong in the research, but very close to that, keeping my head above water, ensuring I can meet my regular financial obligations. So we talked about the debt tracker and the worries that lots of people have about their own income, whether they'll have a job in the future. And that's reflected in this priority to make sure they can continue to meet those obligations in the future. Saving money for a rainy day, we sort of hinted at that earlier. There's a real desire to sort of tuck money away in case of an emergency. We know that many consumers have also used some of their emergency savings already during the crisis, so there's a real onus for those people on replacing or replenishing those emergency savings funds. But also other people that maybe don't have an emergency savings fund are thinking, well, what happens if I lose my job? So there's a real emphasis here on establishing an emergency fund. ensuring that myself and my family are adequately protected in case of an emergency. It's perhaps no surprise that as a result of COVID and some of the devastating sort of stories that we hear in the media, that people want to make sure that they're adequately protected in case anything happens to them. And surprisingly was the confidence in achieving these goals. So we then followed up and said, well, how confident are you in achieving these things? And for the most part, people are very confident. So that's good, I guess. You know, people are optimistic. I think people are motivated to try and achieve these things and take action. The question is whether they're going to be able to. And I guess one of the things, the questions is how can the financial services providers that they use help them to achieve these goals? There certainly seems to be the motivation to want to do these things. And I guess that's the role of financial services companies going forward as an enabler to help people achieve their objectives and their ambitions in that respect. So I'm getting very close to the wire here. I'd hope to have finished by now. So I've already run slightly over. So I'll whistle through the summary and implications. So in summary, the financial service sector changed considerably as a result of the crisis in 2008. No one would argue with that. Consumers remain apathetic towards the financial services companies, with many struggling to see any real differentiation between providers. The new entrants have so far struggled to gain real traction and disrupt the industry. And then we see COVID-19 having a significant impact on consumers' mindsets and their plans for the future. The other point was that, you know, from the debt tracker, those that are already struggling have been impacted the most and are really are facing an uncertain future. But most people, even if they're not already struggling, are worried about their future. And this results in perhaps a sort of large scale conservative attitude. Most people have that sort of more conservative mindset towards their finances. And many are really looking ahead and planning for the future, especially over the next 12 months. So the implications of the research. So we sort of left it with some questions here. You know, how can financial services providers differentiate from their competitors and win greater market share? So we're still in an environment where consumers don't see any real differentiation. So you know, how do you be seen as relevant to consumers and their needs, and then different from the rest, different from the competition? That's still the key prize, I guess, that needs to happen in order to stimulate the market, I guess. How can new entrants survive where consumers are perhaps even more cautious about using unfamiliar brands? I think that's going to be a massive challenge in the short term and perhaps the longer term as well. And how will that more conservative attitude to life and finances impact on consumer behavior? Are some of the things that people are saying they're going to do, will they materialize? We're on this big sort of, you know, a lot of people are talking about changing their life as we come out of lockdown. Oh, I won't do that again. I won't do this again. You know, I'm going to change. I'm going to do things differently. I'm going to build that emergency savings fund. Will they actually do that? There's strong evidence to suggest they will, but it'd be interesting to monitor that as we go forward. And then in the wake of COVID-19 and also, you know, Black Lives Matter movement very recently, I think all brands will be under increased scrutiny about how they're supporting the societies in which they operate. So the onus on sort of driving that buzz score for your brand, I guess, based on what you say, what you do, word of mouth, is going to become more and more important. And I've said we're on the brink of a financial crisis. I think we're perhaps already there. People will be struggling more than ever. So there's a need also not only to show how you're supporting society or how companies are supporting society, there's a real immediate need to show consumers as individuals how you are helping them. So how are you going to help consumers achieve some of their goals over the next 12 months and longer into the future? And we think those things are going to be massively important coming out of lockdown and out of the current crisis. Okay, so that leaves us like 10 minutes for questions. That's probably 5 minutes short of what I wanted, so apologies. But I think Rachel's going to send me some questions. She has done, I think. So I'm just going to see if I can access those. She has sent me loads of questions. I'm not going to be able to answer all of them. Okay, so I'm going to go from the top. Okay, so there's a question from earlier. Does that view look much different when you separate out banks and building societies? And that's from Nicola Dayton. Thanks for the question, Nicola. I think you're probably referring to the sort of earlier stuff we presented around the sort of reputation of banks and things like that. I think the building societies have fared much better So of course, when you look at building societies, they perhaps, as a result of the crisis, weren't sort of bashed as much as the banks. They did sort of better in that respect. So you'd certainly see different sort of lines or different scores for building societies when it comes to banks. The question is, though, why haven't more people left those big traditional banks and therefore joined building societies? And I think that the answer to that lies in the point I made earlier, that the sort of reputational damage is very much at an institutional level, but at a transactional level, i.e., does my bank do what I need and do I trust my bank? The reality is that most people are still generally happy with what they get from their bank or building society. So I hope that answers it, but it was probably asked at a time a bit earlier in the presentation. So if you wanted to follow up at all, I'd be happy to discuss it further. Yeah, the slideshow will be available. 2 secs. Okay, I'm just scrolling through. So the appeal of challenger brands, is it a similar picture for business banking? Yeah, a lot of the research we've done on this has been in the retail space. And I think there is an argument to say that, it's easier for the challenger brands to perhaps challenge within the business banking sector. And I certainly think if we look into that, you will see greater success of challenger brands within that sector. The research that we've done here has mostly been pointing at the retail banks, which is more of a mass market challenge. But certainly I think the reason that challenger brands are perhaps more successful within that business banking space is there's more opportunity to perhaps offer something different and new to what's already out there. Within the retail banking space, I think it's fairly difficult to identify real sort of moments that matter or tangible things that you can offer that really resonate on a sort of mass market footing. So hopefully that answers that one. Okay. 2 secs, I'm just scrolling through. Okay, Joanne Brocklesby, how do you define financially distressed here? Financially distressed, the definition is from our debt tracker. I don't have it to hand, but it's you have to agree with one of a number of statements. Off the top of my head, one of them is I am struggling to keep up with my bills or financial obligations. So there's a definition. I'd be happy to share that offline, or if you wanted me to send you some stuff on the debt tracker and exactly how it works, I'd be happy to do that. The proportion of UK adults that fall into the financially distressed category, Dan, thanks for the question. That was in a previous iteration of this deck, but I removed it because I thought I won't get through everything. It's 12%, so 12% of the population we have defined as financially distressed. So 20% of the population was the slide I put up, which had been impacted as a result of COVID-19 in terms of their employment. 12% are financially distressed. Okay, Sam Barber, any correlation with BAME community and C19 impact financially? We can look at that. I haven't yet, but we'd be happy to take a look at that and see if we can spot any differences. I'm pretty sure we can do that analysis on our panel and certainly be able to reveal that. So perhaps I'll take that one away, and if we can come up with something, we'd be happy to share it with you, Sam. Yeah, a question from Jason. I'd be more interested in AXA or Hiscox brand buzz as they've been in a battle with their customers. Yes, we're aware of that, and we can track those brands via brand index and look at how some of that has impacted on their brand equities. That's certainly something we could do. Apologies if it wasn't included in this presentation. But yeah, we wanted to include a sort of positive story rather than going down on the sort of more negative side. In terms of, I'm scrolling down to the bottom now just to get some of the latest question. Jason, you asked how has the use of cash percentage changed? Within I believe it's we have a number of trackers related to COVID. One of those trackers does exactly that. We are tracking the usage of cash as a direct result of COVID-19, and we have seen an increased percentage of the population not using cash as a result of COVID-19. And it's one of the things we think will be sustained as we come out of the crisis. I think people, maybe the people that sort of were always used to carrying cash or using cash have now realized that they don't need to. They've perhaps used contactless more than they ever have. And we think that sort of behavior will be sustained coming out of the lockdown. So what do consumers class as non-essential spend? That's a good question. I guess within the question we ask, we the way we captured this information is we presented a statement to our panelists and says, which of these things are you likely to do? And one of those was cut down on non-essential spend. So really the answer to that question, may differ depending on the consumer. In order to explore that further, we would probably need to do some qualitative research or some follow-up work, maybe some open ends as an attachment to that question, but we could reveal whether there is any sort of real variance between one person's definition of non-essential spend versus another, which I think there would be, and would be quite interesting. But for the purpose of this work, it was mainly just to identify whether there is this mindset of sort of cutting down on things that perhaps you don't need to spend money on, rather than sort of identifying exactly what those things would be. So what do we think the challenges are for insurance providers in the post-COVID world? Will financial distress lead to less insurance purchase or more as people take a conservative, risk-averse attitude? Thanks, Sue, for the question. It's a good one. I think initially this data would suggest, there was one data point in there, certainly from a sort of life insurance perspective and that sort of protection side of things. We certainly think that there will be greater emphasis or greater focus, or people will be reflecting and thinking, do I have adequate protection in case anything happens to me? So from that perspective, we think there is every reason to believe that consumers will be more engaged with that or more open to those sorts of discussions, and that may result in more need for those products and services. From a general insurance perspective, I think it's obviously it's a different product and a different area altogether. I think that the only thing I could suggest off the top of my head, we haven't focused on this specifically, is that in this sort of environment, people may be more encouraged to shop around, especially when it comes down to renewal. There is a real emphasis here on sort of cutting back on non-essential spending. So that's probably going to culminate in people thinking, well, am I getting the best deal on my insurance policies, and perhaps they're going to shop around more. Other than that, I think we would need to do some more research specifically looking at that sector to understand the sort of changes in more detail. We certainly know that within the insurance sector, there has been this historical view that, I don't trust insurance companies to pay out and things like that. Whether or not people will look more into their policies and what it does or doesn't cover. We know that there's sort of loss of earnings cover. That was perhaps a surprise for many people who thought they had cover in that respect, or at least thought that the provider should pay out for those claims, even if it was written into the small print. So whether or not it's going to lead to more scrutiny as to exactly what insurance policies do or do not cover, that may well be the case. Okay, so there was lots of questions that have come through, so I've kind of just skipped through and answered as many as I can within the time we had left. So apologies if I didn't get onto your question. There looks to be lots of interesting questions there, so we'll copy those questions out of this chat facility. I will then answer all of those questions, and we'll send you the answers of those questions alongside a copy of the presentation and a recording of the webinar. I think probably later this week, but I'll have to speak to our marketing team, Rachel and Ruth, who are on the call, just to figure out when that's going to be. But thank you very much for attending. Really appreciate you giving up your time to listen today. Hopefully it was interesting. If you wanted to ask any further questions or have a conversation about anything that you've heard today, let me know. My email address is in the presentation. I'd love to hear from you. But in the meantime, enjoy the rest of your day, stay safe, and hopefully speak to you soon.